The subtitle is "The Story So Far" in your paper, I agree with you. Like, we're early in this story. I mean, most of the growth in this is literally in the last 9 months. Obviously there's been experiments in this for 5 years, but like the story so far is we're really, really early. Maybe talk a little bit about from your perspective, the why now. Why is this happening so pervasively right now? We'll go from there.
I can hop in there first. Maybe Nick might have some different answers, but I think there's a few things that are really top of mind. One is that just the overall strength of the US dollar as sort of the unit of account and the kind of the supreme apex predator of money on the global stage is really a big reason why there ought to be a lot of support behind things like crypto dollars, US dollar-backed instruments. If you look at some of the movement coming out of China and just what that would portend to do on a geopolitical scale if certain types of transactions on a global level, commodity sales, for instance, were to be denominated not in US dollars. So I think there's a lot of attention being paid from the higher ends of the US government around that use case. Along those lines, kind of the story why now, I think there's a big move to be made here by some of the larger just payment providers in the United States. And so if you look at some of the PayPals, the Visas, the Facebooks of the world that all have teams and really smart people mobilized around this, I think it's seen as a next frontier opportunity that can really expand access to financial services in ways that you really couldn't do before this. And it can expand the aperture of what is possible when we get into some of these programmability issues. Really look at some of these technologies becoming foundational for the next generation of internet services being built on top of them. And I think the third thing that I would say in terms of the why now is that there are a lot of just forces from a capital markets perspective that make this a really interesting new market to enter. So when you think about some of the opportunities just around the market structure here and the lending and the borrowing, you have a lot of firms that are moving in that are looking at this as a real extension of things that they're already doing in the capital market space. And almost look at the infrastructure behind US dollars hasn't been changed a lot in the last 50 years, right? We have big industries there.
The base layer, every other function in the capital markets is kind of built up on that.
Right, and then, we have these well-functioning repo markets and money markets, and I think in a lot of ways, this is the next generation of that. And we're just at the very early ages here, but that is all getting built. And so when you think about stable coins and yield generation and some of these interesting things you can do, it's fairly obvious if you're a market participant what these, the addressable market here is huge. And so it's pretty clear that we're going to have some really large businesses built in some of these categories. And so I think that's another thing that's pushing this industry forward, this sector.
Mm-hmm. Yeah, I can chime in on a couple more specific things. I mean, first of all, we're just seeing this secular move towards people understanding how to use digital bearer assets for the first time. And before 2009, that was never a thing that anyone had to worry about, pretty much. And the technology didn't exist to facilitate that. And we had to start pretty much from scratch in 2009. And so it took a decade or so until we had the tools suitable to transact with value in the form of information. And that was a really difficult and challenging time. And a lot of people lost all their Bitcoins and so on, learning that lesson. And now the software stack has kind of progressed such that we can transact safely and not have to worry about it too much. And you look at the data, I mean, the Cambridge study says there's about 100 million individuals worldwide that have ever used a cryptocurrency of some sort. There's obviously caveats to that estimate, but I consider it to be fairly reliable. And 5 years ago, that figure was much, much less. So that number is just increasing, that's to the general growth characteristic of the industry. We've got a lot further to run, but that just means there's a much larger installed base of potential users for these things. So that's one reason why now, I think, is that there's just more people and more capital that's willing to allocate their assets to public blockchain-based digital assets. One catalyst that was very clear to us was after the shock, the risk-off event in March 12th, some of the traders we talked to were firmly of the opinion that there were some crypto businesses that had their capital denominated in dollars, but not in crypto dollars, and they were unable to move fast enough to, exploit that situation where Bitcoin wicked down to, 3.5K or something crazy.
Right.
And so then after that, they realized, okay, we need crypto native liquidity.
Keep working capital, and that's a trend we see. I mean, we see so many, blockchain native firms that are opening up accounts and who are, their use cases are first party payments and working capital, not just trading. And I mean, it's obviously this is like early adopter to some degree there, but it's clearly an interesting indicator. It reminds me of another thought. I was just asked a question. One of the things that's been interesting about, I'm just narrowing in on USDC for a moment. When you see USDC in circulation growing, it continues to grow even when the market goes down. It continues to grow when the market goes up. When there's low volatility, it continues to grow. And so in some ways people are saying, is USDC uncorrelated, or what's the correlation? Why is that? And that's something that we've noticed, obviously, as well. And there's some really interesting things going on there, which relates to your comments, which is, I think one was, when the investment asset markets are rising, more capital is coming into the market, right? So by definition, there's sort of more capital comes in. It comes in through tokenization. It comes in through things like USDC. And then once it's in the market, there's holders of it, and they prefer to hold it. It stays sticky, because the people who've already decided they like crypto dollars, when they're receiving those on the other end of a trade, or they're holding them, they want to hold them. So it generally stays sticky. But then when the market is selling off, people are selling into things like USDC, and they want to get out of whatever coin or whatever that they're trading, and they want to get into USDC. And again, they're crypto native, and so they're sort of saying, well, I'm just going to keep it in this, and then when I re-enter the market, I'll be able to do that, exactly to the example that you gave, Nick. And then the other is obviously the rise of DeFi and all of the protocols that are out there on the yield side. And so when it is idle, or when people are holding it, whether it's as working capital or investment capital or what have you, they can put it in a yield protocol and generate daily yield with instant liquidity that they sure as hell aren't going to get if they withdraw it out into native electronic commercial bank money. And so that makes it even more sticky. And so there's a little bit of a flywheel going on that. And then I think the thing that we're paying attention to is at what point does that go from just kind of working capital management into the sort of deeper forms of payments and settlement and treasury and other activities that firms have, where the advantages are so superior as well. And obviously crypto native firms get that, but when does that cross into, as you were saying at the very start, like this new form of commerce activity that becomes possible?
One of the interesting things there is the OCC stance recently around stablecoins, some of the clarity, and I know you've been doing a lot of work educating folks on that front. But to me, that just opens up the addressable market of deposits that are allowed to do these type of activities. And it's not just the DeFi for the yield. I mean, you can use Genesis or BlockFi to generate a much bigger yield than you would on a traditional money market. So to me, that OCC thing is really worth paying attention to, and we'll see.
Absolutely.